Start. Global financial markets may be exhibiting recovery following the dramatic falls in value, but the global economy is still in uncharted waters. Employment generation in the US has been weaker than expected, threatening in the fragile post pandemic recovery. The Bank of Japan's decision to raise interest rates after years of keeping them low has also rattled financial markets, setting off a reversal of equity flows and a collapse in Asian markets. These rapid turnarounds have come on the back of attempts by central banks to combat the problems of inflation and repressed economic activity using the tool of interest rates. What the current situation indicates is the difficulty in implementing monetary policy in the presence of global financial markets, where expectations display heightened volatility and large scale drops in asset values can occur much faster than the ability of policymakers to respond. The current consensus regarding monetary policy is to assume a trade off between unemployment and inflation. Central banks raise interest rates as inflation rises, reducing investment and hence slowing aggregate demand. This leads to a reduction in the demand for labor, reducing the ability of wage earners to push for higher wages and ease inflationary pressures. There is, of course, a lot of debate regarding the proper conduct of monetary policy. Several have criticized the normal conduct of monetary policy, stressing that solving inflation by increasing unemployment represents an unfair burden being placed on workers everywhere who are already grappling with a cost of living crisis. Instead, they argue inflation could be better tamed by forcing companies to reduce their profit margins and by breaking monopolies. Let us accept the current consensus regarding the conduct of monetary policy. The release of a jobs report that showed a less than expected increase in employment led to fears of a recession and caused a rapid sell of equity stocks. This, coupled with concerns regarding the less than expected performance of big giants, led to a rout in the stock markets. What is of note is that the economy was not actually in recession. The market just expected one to occur. The rise in unemployment rates triggered the sham rule, which mandates the automatic disbursal of unemployment checks to households when the increase in unemployment